Good morning, Tuesday, March 17th, St. Patrick's Day. Morning brief here on Yahoo Finance. I'm Miles Eldon. That is Julie Hyman.
Not wearing green.
Not wearing green. And this is Josh Schaefer from Barron's.
Yeah.
What's your actual title?
Newsletter editor. Barron's Investor
editor
Circle newsletter editor.
Great to see you back on our air. All right, let's start today's proceedings looking back a little bit at what we saw yesterday, and that was from Nvidia, Jensen Huang giving his big keynote speech at the GTC conference, and the big headline, Julie, very big number, $1 trillion.
Well, you have to say it's sort of 1 trillion.
Is that the way?
I don't know.
We're doing Dr. Evil with it?
That's very throwback. Okay. Sorry.
$1 trillion in AI sales through 2027. This really brings me to what I think would be a Julie Hyman not buying it segment, not impressed segment. Where are we at on this?
Well, I mean, yeah, I mean, it's the law of, is it the law of large numbers, whatever that is? It's like, okay, fine, $1 trillion, that's great. And it turns out, as I look around in some analyst commentary this morning, their estimates weren't that far from $1 trillion. Yep. They were already, like, I saw one estimate for 970, one for 989. So it's like $1 trillion, okay, that's great. I mean, Stacey Raskin over at Bernstein, who really knows the chip industry really well, he seems to think there's a considerable amount of upside to that trillion. So I guess then if Nvidia at some point comes out and says, actually, it's not $1 trillion, it's $1.5 trillion or something, then everybody will get all excited again, or not.
Yeah.
I mean, I think it's less about the fundamentals of the company, which, yes, $1 trillion is impressive, but, like, is it impressive enough to move the needle is the question.
No, because if you think about $1 trillion is just a big number and we expect Nvidia to just beat big number, like we've been doing that narrative for 3 years, right?
Yeah.
Like, okay, like they're gonna put out this ridiculously large number, pretty eye-popping. It's probably actually a little bit low, right? Because why would they guide for something that they're not going to make? That would just be poor management, right? They're not going to throw out $1 trillion if they don't actually think they can make it. So they put out this big number, and I think that's what, I mean, the stock moved 1.5%, right? It didn't, stock pops, like it didn't really pop here, right? So I don't think that the trillion number is really what to grab onto, because I don't think AI demand has been the question of the last couple months, right? Was anyone worried that Nvidia wasn't going to sell more chips than we thought over the next 3 years?
Right.
So like that was not my AI question during the sell-off of the last
So one
month.
thing, I want to follow on this specifically, but just to kind of wrap up some of what was announced yesterday.
Yes. Yeah.
This is mostly for my own posterity, kind of reading in here. I was off yesterday. So they've got a deal with, we've got NVIDIA-powered Ubers. They're going to be hitting the road in a couple of years. They were out talking about Nemo Claw. So this is the old Claude bot, which became Moltbot, which then was bought by Meta. So this is agentic AI, kind of at its maximum extension. NVIDIA brought Grok last year, some announcements around that. So we get a whole bunch of product releases here, which is what this is. This is a product event. And Josh, your discussion about how we're managing the story is something Julie and I talked about last week, which was how much is this, like where are we at in that cycle of Jensen feeling like he needs to talk about the stock or manage this story, because all of a sudden we're working on month 9 now of Nvidia stock having gone nowhere.
He is talking about the stock story, because the stock story for 27 and 28 is Uber, right? It is, do we get into autonomous driving? It is services once I have the chip, right? Okay, you sold me the product. We're talking about tech here. What do I do with the product? How do you get recurring revenue, right? So I think that is the next leg of the Nvidia story to me. Like, yes, it's not a next quarter earnings story, right? It's probably not a 26 story, but it is a 27, 28 story to me, which is, all right, everyone's gonna get all these chips. Nvidia's gonna sell all of these chips. If I'm to believe that this is not just a chip cycle, right, where you sell all of these chips and then I have the chip, like where do I go next with it? It gets into some of the services aspect of this. So I think, I remember you and I talking about this a year ago, Julie, with the quantum part of all of this, right? And it's like, so what's my next lever that I'm gonna pull so I can continue to believe this growth story and it continues to trade at such a high market multiple?
I mean, the other thing I would say about yesterday, so the Uber announcement had already been made. It's the timeline that's new. For example, all of the other announcements except the $1 trillion number had effectively been leaked or reported upon, right? So the OpenClaw thing had been talked about. We talked to Dan Halley about that before the announcement happened yesterday. The Grok, what they were going to do with Grok, that they came out with what they're calling now an LPU, a language processing unit, a bigger Vera central processing unit that they're talking about as well. Okay, yes, the Vera Rubin space module, I guess, is a new thing, but that's not like going to be a huge product for the very far foreseeable future. So like, maybe Nvidia, part of Nvidia's issue stock-wise is they have mapped it out every step of the way very, very clearly, like far out into the future. That's what they do. That's what investors have become accustomed to. So then if the roadmap is clear, then it becomes harder and harder to, that.
So I don't want to press on this, but like, does Nvidia have a stock problem?
Well, okay, so I'm glad you said here. Like, can I show a chart?
Yeah, go ahead.
Okay,
Go ahead.
So here I'm on.
going nowhere. I'm aware.
I have
but
Nvidia
like,
up on the Wi-Fi Interactive. Okay, just to like put a fine point on this, I'm going to play Jared Blickery, our markets and data editor, for a second here. So here's Nvidia over the past year, and here is where I draw, sort of wiggly lines that are supposed to be straight lines, and show the range that it has been in since last August. The top here was late October, and since then it's down 11.5%. Yep. So it depends on what
the crypto peak, basically.
It depends on what your definition of problem is, right? Like it depends on
because I could look at up 50 in a year, and I'm like, it's pretty solid.
I mean, I would argue, in Jensen Huang's mind, this ain't a problem, right? It's not a problem for him personally. He's doing fine. It's not a problem for anyone who got in before here. It's not really a problem in terms of all of the spending that they're doing, because they're not really using their stock as a lever to back up, their spending. So I don't know. It depends on who for. If you want to buy it right now, and you're expecting to go up tomorrow, maybe it's a problem.
Yeah, I guess the thing that I was wrestling with is like comparing GTC to WWDC from 15 years ago, back when that was like, had all the same characteristics of, it's a tech product conference. It becomes interesting for investors because Apple at the time, it's like, how many more iPhones are they going to sell? All the parameters of the iPhone were leaked before the presentation itself, and then Steve Jobs got up there and did the whole thing. And I just sort of wonder if it's this moment where you have the technologists and the stock guys just talking past each other. And and I think it brings us back to the story about, do they have a stock problem? I would say certainly not, but I think that is just a question on what your horizon is or et cetera, how you define a problem. But it brings us to, I think, the general thought around the AI trade, as it were, which is the state of the Mag 7 trade. I think in many ways Nvidia remains the perfect avatar for the market, because the stock's been flat despite all kinds of problems underneath the surface and stuff happening overhead. But another member of that group is Microsoft, which over at Barron's was on the cover this past weekend about a stock that you guys, whoever's banging the table on this one, right? That's how it works. And that stock is down, 15% year to date? Like that, again, underneath the surface, this has been a struggle. They're on the struggle bus in a way that Nvidia isn't. So maybe Nvidia's, they are outperforming them.
If you want to look at it that way, for sure. Microsoft was down 30% at trough from a 52-week high, right? And so part of the...
That's a big number, by the way.
30%.
That market cap, that's serious.
Right, and if you're holding on to that stock, you feel 30%, right? And I think that's been a broader market conversation that you could have, right? Which is, there's been a big mess under the surface, right? We can talk about the S&P 500 going nowhere, but a lot of names have fallen 20%. But I think with Microsoft, sort of what ended up becoming the interesting part of the story is buying Nvidia right now, so we were just talking about this, right? Getting in right now, what's your bet? You're just long AI demand, right? You are long the success of AI. You are maybe in some ways long the success of the AI takes over software trade, right? You're all in on just AI is going to be everything. We sort of looked at Microsoft and said, well, maybe it works both ways, right? So they have the OpenAI investment. If it fully takes software away, your OpenAI, even just your OpenAI stake would probably take off, right? If that became sort of the dominant theme, maybe Microsoft works in that trade. Or what if software stays and you're buying maybe the best software company in the world, or at least one of the top 3 software companies in the world that is incorporating AI, and it can work that way too, right? So you sort of have 2 ways. You have 2 ways for it to work versus buying an AI chip company is simply buying the fact that we're going to continue to consume more AI.
I have to admit, when I was reading it, I was like, oh yeah, it owns that big OpenAI stake, and this is how much it could potentially be worth.
That could work out really
well. It's a nice little buffer that you have. But I think we've become increasingly convinced. I don't know, I can't speak for Miles. I've become increasingly convinced that this whole software is going to get eaten. I've been increasingly skeptical of that. And by the way, the market has too. We've seen IGV. It depends on the company. I think it's going to be company specific, and it's, and maybe eventually it's going to happen, but it's not going to happen right away. et cetera, et cetera.
You know what I think is the funniest thing about the software trade is that it seems obvious that software is not going to be eaten by vibe-coded AI solutions, which feels like, yeah, I mean, of course. We work at a large company, and like watching the install process, watching the bid process for a new tool to use, how the RFP, like the whole thing, right? It could take multiple years to get a new tool installed in a company of this size. And Yahoo's not even that big relative to a lot of other tech competitors anymore. So that seems like obvious. Then on the other side, I'm recalling the comments that we saw in the press that were leaked into the press yesterday from Apollo's John Zito at a UBS event that were supposed to be off the record. They came out in the Wall Street Journal yesterday, where he referred to Joe's software company, which has been the big trade within private equity, within private credit. And that feels like maybe it's not even an AI trade. That's just like a, hey, this business isn't worth 12, 15 times EBITDA because it works for like 14 different dental clinics in the Southeast. Like, that's not a 15 times EBITDA company, regardless of whether there's an AI trade, an AI problem for them. Like, that product might be fine, and they might still be able to land and expand, do all the things that a private equity or some kind of private capital buyer is excited about with these software plays. It just isn't worth that. So I feel like I'm talking out of both sides, and I think the market is trying to figure out why these two things are happening at the same time. Like, why do we have a quote unquote problem with private backed software play, like tiny software plays, and also then say, yeah, but I don't think that we're gonna all of a sudden see Workday displaced for this kind of, it feels like an interesting tension.
Well, it's a moat thing, right? Isn't that essentially what you just brought up there? Like, if I only am serving 12 companies, no matter what their size is, in some small region, like, that's just a way less attractive business than Workday, Okta, who has clients all over, right? Like, you have this big moat of companies, and like that kind of became the big question. Like, the Citrini piece was essentially like, okay, we're just gonna like take the wide moat theory and throw it out the window. No one cares that everyone has Uber. We're just gonna get rid of Uber. We're gonna get rid of DoorDash. But like, I think that's been the bull case for Okta, for Oracle, et cetera, is they do have giant businesses. Maybe they're still not worth what we thought they were worth 3 months ago, right? Yeah. Maybe the terminal value is a little bit lower, but the terminal value isn't below 20 times next 12 months earnings.
Well, and then maybe I guess so we can work through this here. Maybe the problem then for Joe Software is that if Workday's stock is down to 30% and Workday was seen as the logical buyer of this certain solution, then your takeout price is lower. So therefore, you went in and took the thing out at 12 times EBITDA, thinking Workday'd buy it at 16. Now they're going to buy it at 8.
You know what I'm thinking of for some reason? I'm thinking of pre-2020 MicroStrategy. Right? Here is a software company that was founded in the 90s, went through the dot-com bubble, and then just kind of stuck around and didn't grow for like decades, right? In other words, like, just because, yes, these companies may be worth less, they'll just kind of like hang out. Even the biggest ones, even if they have a moat.
You said MicroStrategy, right?
MicroStrategy, aka what's now known as Strategy.
Right.
It's a business software company, if you recall.
But it's not.
It was.
No, it is.
It was.
So like Adobe should buy Bitcoin?
I know.
It still has that business. That's what I'm saying. So forget what you know about MicroStrategy now. Think about MicroStrategy in 2019. Okay, before it got into crypto. It's just a business software company, but it's one that didn't do a lot for a long time. So like, is that what some of these companies become? Or it's like a retailer that just kind of like
you become an uninteresting software company.
Maybe it's going to die at some point, but the death is long. Like it doesn't mean they're going away forever.
Can I interest you in a continuation fund? To retain a portfolio company that maybe has gone X growth, but throws off plenty of cash.
So it's a special SCV, a special continuation vehicle.
Well, I think that this is probably where, as a private investor, you can get pretty comfortable, to use their terminology, with a portfolio of software names that maybe the takeout price is not what you thought it was going to be, but with that's what the rise of continuation funds to me is really about. Is like, how do we figure out as an investor a way to hold on to companies that throw off a lot of cash, but may not be able to generate the big exit that we were looking for.
Right.
And preferably are not retailers, because retailers just go out of business. Software companies, like, again, a small chain of dental offices has kind of the same problem that a big tech company like Yahoo has, which is it's a pain to take in or replace systems.
Right.
Regardless of how large you are, there's other things you want to do that don't involve installing a new software solution or taking an old one out. And so there's still, like, the recurring nature of the business is not a made up thing. That is a very real thing, and that's kind of why it all got hot in the first place.
Well, and I mean, the credit side of that, like the private equity firms more depend on the exit, the big exit, right? Private credit is built upon that very thing that you're talking about, right?
Yes.
It's supposed to be boring. It's supposed to just like throw off a return over time.
That was the part of the quote from the Journal yesterday that just killed me.
Which part?
When he's like, I go to, John Gray, he's like, I go to investor meetings.
Zito,
sorry, excuse me. I know, I'm getting my Johns mixed up, excuse me. John Zito is like, I go to these meetings and I'm like, the equity is junior to the credit. And then the other guys are like, it doesn't compute to them. That's actually how it works, like within the capital stack, to your point, Julie.
Yeah.
So, all right, let's move from private credit to, I think, someone who might get a question about private credit tomorrow, which is Jerome Powell.
Sure.
We have Powell's expected to be his second to last press conference.
Expected to be.
Make
sure you're including that in your stories now. Expected to be.
We will see.
Might not be.
But Josh, I think you came to us with a take about the Fed, the stock market, and kind of where you see this playing out.
Yeah, so I'm still working through this take, which is perfect.
Workshop
So this can just be Miles will poke holes in this as I develop it, which is exactly where I like to be.
All right.
I think the Fed not cutting this year is your bull case for stocks at this point. So we're starting to get into this argument of, we're pricing out cuts, right? There's all this worry about the potential energy shock you might see in the next couple months. Maybe they can't cut into a shock, right? So they'd have to wait to the back half of the year. So maybe that plays out, right? And you get a cut in the back half of the year because inflation comes down, your labor market holds on. I think we can all agree that's also still a fine scenario for stocks. But I don't know how likely that scenario is when you already have core PCE perking up in January, then you're waiting for February, then March, you're going to start to get at least some version of an energy shock, right? So if they hold on and don't cut, to me, that tells me the labor market held on in 2026. And that becomes the bigger story. And I think at some point, everyone wants to talk about inflation right now, and I understand why. It's what we're waking up and checking oil prices every morning. I understand like where we're at right now, but like let's not forget that the labor market is on very thin ice here. And so if you're going to cut 2, 3, 4 times, we sure those are good cuts? We want those cuts? I don't think I really want those cuts. And that's probably the only way that you get more than 2 cuts this year is if they're just cutting because the labor market is weak. And that's how you get, because remember, it's going to be the committee here. You got to talk the whole committee into cutting.
It can't just be Kevin Warsh.
Yes.
Right.
We can't just do the Warsh is going to cut because Warsh is going to cut. That's not how it works.
Well, and it seems, to your point, it seems less likely now that they'll cut because inflation is allowing them
like the soft landing
do
cut.
So. Yeah, I mean, yes, maybe. I mean, but is that a good scenario for stocks?
I think it's a fine scenario.
If they're not cutting because the labor market is rolled. I mean, so Mark Zandi was out with a thread this morning, and I know I know economists like to give us percentages of what the potential scenario could be. And he says there is mounting evidence the economy is struggling and recession risks are high. I love that he says economists will be loath to utter the word recession because they keep getting burned. They keep saying recession's coming.
I think he's right on that.
Now.
He's saying
but
right
he
now.
says if oil prices remain elevated for much longer, he's talking about weeks and not months, a recession will be difficult to avoid. So yes, of course, stocks can go up even if there's a recession that's expected. But I'm not sure that.
But in that scenario, okay. So, but that wasn't my scenario, right? So then I agree that's not good for stocks.
So
that's a recession scenario. You would get
labor market
rate cuts.
weakening without us going into a recession.
I'm saying labor market just holding on. Yes. Like if you could pick a steady state right now, it would be hopefully to not see 90,000 jobs lost again next month, right? And you get to your break even over a 3-month period of like 15, 20,000 jobs. Unemployment rate hovers in like a 4.5, 4.4 range. I think that's fine.
So you're bearish on stocks.
How is that bearish on stocks?
Okay, so as I was
If that doesn't happen,
no, as I was listening to the take, I think, and I think the idea that the Fed doing nothing ends up being good for stocks on the labor market, I'm on board with that.
Yeah.
But if I look at the way the market has acted this year, and we look at sort of what are the, back to the idea of what are you getting excited about with Nvidia stock, okay? What are you getting excited about with all of the stocks generally? Right now, the S&P's answer is
Rate
nothing.
cuts.
Well, you're not getting excited about anything, right? The S&P's flat basically year over year, which means you are re-rating lower. Earnings are not going down this year. Earnings are going to go higher. So if stock prices don't go up, that means the multiple on the market is coming down. So the Fed doing nothing because the labor market held on is basically saying the base case for the markets is that the situation is going to get worse, and the Fed is more likely than not to cut more aggressively than anticipated as a result of a deteriorating labor market. I think your outline, which again I'm on board with, is sort of pushing back against a base case of, the economy is going to get way worse and the stock market's going to go down this year.
Right. Or the other scenario, which I think has started being introduced, which is the concept of, in my scenario, I didn't mention a hike once, right? We haven't used the word hike yet.
No, because that's not going to happen.
Right. Yeah. But that's the other ultimate bear case scenario, I guess. But it doesn't really even
it's not going to happen.
It doesn't really even make sense to me.
No.
Right.
No.
So
it's not happening.
Because
inflation goes up, but then again you go back to the recession point, right? So it's like, how could they really hike into that?
Well, because again, Kevin Warsh he'll be the chair of the committee most likely, but you have to have a certain number of votes amongst the committee. He is, even though he may not get all the cuts he might want, certainly his existence as the next Fed chair is going to take off the idea that we are not going to look through some inflation shock for a rate cut.
Yeah, I mean,
that's why it's not happening.
Yeah, I mean, even if you look at the existing Fed members, none of them is so concerned about inflation.
Yeah.
At this point, yes.
Yeah. So, I mean, unless we
Miles,
get a crazy.
Miles talked me into it. We need one 25 basis point cut for stocks to go up.
What I love about this is Josh has written a story. Miles is editing. We're getting it's like a flashback to me in time.
I haven't written the story. Maybe I won't write it. Maybe I will.
I'm just saying in theory.
This is the experience everyone can get.
This is the process.
We go back to that.
I like it.
All right, what do we got? We got a minute and a half here. Go ahead, Julie.
It's not enough time to talk about sports betting. I've been wanting for days to talk about sports betting.
I was going to do a minute and a half on it. Go.
McKay Coppins, who is a well-known reporter for The Atlantic, who also happens to be a Mormon, got dispensation, reluctant dispensation from his bishop to engage in a gambling experiment on behalf of The Atlantic, where they staked him, and he was still going to collect some of the profits, of which there were negative profits. Yep. And reading this, I'm already very skeptical of sports betting and prediction markets and their effect on society, and this made me even more so. And here is Josh Schaefer, sports fan. I think of
sports
you.
fan, and right in the peak demo of people that sports gamble and prediction markets.
And how much do you gamble? Do you gamble a lot on?
Occasionally.
Yeah.
Like $10, $10 hands.
But
I think the Patriots are going to win the Super Bowl. You put $10 on it.
But most of the sports betting platforms make most of their money from 10% of the gamblers, who are the people who are all in.
Yeah.
And probably not all in a terribly healthy way.
Yeah. I just I'm not. We have 30 seconds, so we can't do the is it good or bad for society thing. But I'm not really there. There's a lot of stuff that's bad for society. The economy's growing. There's going to be more things that come up that are bad for society, right? Wow. This is how economies work as they grow over time. We get more money.
Self-responsibility, Schaefer.
Yeah,
There it
Social
is.
media is bad for you too. It's addictive. Don't let your kids on it.
Sure.
Yeah.
That's great.
Guy with no kids
That's
says.
it? Just personal, just libertarianism? That's where we're going?
Yeah,
That's the
I think light libertarianism.
It's like
sprinkle of libertarianism in there.
Light.
All right.
Yeah.
All right, we gotta go.
That's fun.
That was fun. Josh, thank you so much.
Thanks for having me.
Great to see you. Opening bid is next with Brian Stasi. One of the
Good Tuesday morning. Welcome to Opening Bid live from Yahoo Finance's headquarters studios in New York City. Here's what's on my mind right now, because I know it's also on your mind. First, you're probably wondering why Nvidia's stock isn't exploding higher after Jensen Huang's highly technical keynote at its GTC conference yesterday. I have that answer, or at least I think I do. Nvidia previously cited about $500 billion of high confidence demand in purchase orders for Blackwell and Rubin chips through 2026, and now it said it sees in excess of $1 trillion through 2027. Despite the buzzy $1 trillion headline, though, some of this was expected by the street, and the revenue growth rate from 2026 into 2027 for Nvidia could flatten out. Investors don't want anything flat as it pertains to Nvidia, like nothing at all. You're also probably wondering the next move in the market with oil prices plastered above $100 a barrel because of the ongoing war in Iran. I don't have a precise answer on this, full disclosure, but I will say this: the smart money isn't feeling the bullish vibes. BofA's new fund manager survey, love this thing, shows investors raising cash levels and having a way more pessimistic outlook for the economy. So lots going on with this survey, some of it not so hot. Here on the Opening Bid Roundtable, Dan Ives, Wedbush Securities Managing Director and Global Head of Tech Research, alongside Yahoo Finance Senior Reporters Brooke De Palma and Inez Ferre. Good to see you all. Dan, good to see you wearing green. I clearly missed that memo. That's my fault, not yours. You were at GTC. Bring us inside of that room. What do you think about what Jensen had to say? Not really seeing the stock, I would say, explode higher after this event.
Yeah, solid. And again, disappointed with the no green, but again, it is what it is for you. Look, I think I get what, the street in terms of more of a shrug the shoulders in terms of the trillion. I think that's the wrong move. I think the reality is you're talking about $1 trillion in demand that they already see going out over the next year. And that's only 3% of enterprise have even gone down the AI path. I think this was really a GTC speech that outlined the product roadmap, not just for NVIDIA, but the AI revolution when it comes to physical AI. I don't see how you walk out of there not bullish.
All right, Dan, so if GTC, Jensen's leather coat, or if that's not going to get this stock going again, what has to happen? Like, what's the next big catalyst for NVIDIA? Does Jensen need a new red leather jacket?
Yeah, exactly. Look, I think he sticks with black leather jacket. But look, I think it's really about, right now, this is an AI ghost trade. I mean, let's call it like it is. In terms of what we see with the software sell-off, worries about too big to fail, circular finance and everything else. I think this is just step by step. You're going to see the monetization that's going to start to show up, especially in the March quarter. And you're going to see that throughout the year. And what that speaks to, and I saw it at Palantir last week at AIPCon, this is happening at almost a stunning rate in terms of this enterprise demand. And the demand to supply will be in Asia in a few weeks. Right now, it's 12-1 for NVIDIA chips.
Dan, who won the conference war, Palantir or NVIDIA, over the past 2 weeks?
Well, I think Palantir probably initially won it. But I also think NVIDIA, they're a victim of their own success because that bar continues to be so high, which is why I believe this is a stock that should be up, not down. And we say like base case $300 in terms of for NVIDIA. I think we're looking at a $6 trillion market cap in 2027, despite this white knuckle period.
And as I just put out a post on X, there's a chart, not to mention a competing firm when our man Dan Ives from Wedbush is on. This one came from Deutsche Bank. They pointed that software stocks have come back over the past 2 weeks. These stocks were absolutely obliterated, but we are now starting to see some buying after a long period of selling.
Right, so perhaps the selling that had been going on with software was overdone, like a lot of analysts had been talking about, that it was really overblown when it came to software. But look, the fact that Nvidia stock didn't move that much, maybe it's a good thing. I mean, what Dan was saying is, yes, this stock is basically the highest very bar. It is priced to perfection. And the fact that you saw all of these everything that Jensen Huang was saying during this conference was things that already the street may have known already, but also the fact that he talked about 2027 for Uber. This is very, to me, that's big. And maybe this street needs to see, maybe investors need to see all of this playing out over the next year, what Jensen Huang's talking about with Uber and self-driving 2027, that's huge to me. And Olaf on stage, I thought that was fascinating.
Yeah, Nvidia is just working on some amazing things. Brooke, let me get over to you. Good note this morning out of the folks from Citi pointing to, I think one, they were pointing out that you may not see Meta lay off 20,000 workers, as has been chatted about. But you look at some of the efficiency gains Meta is driving in its business because of AI, it is mind-blowing. You have to think, yeah, maybe they will lay off 20,000 people.
Yeah, and what we're hearing from that Reuters report is about 20% of its workforce could be let go. And also, too, what Citi had pointed out is that Meta's seeing a 30% increase in their output because of these AI agents that they've initially put into place here. And so they noted that with that sort of layoff that could be on the table, not confirmed by Meta just yet, that could mean reinvestment in Meta's 5 core priority areas, they put it as. That includes infrastructure, monetization, reality labs, Gen AI, and regulation and compliance. And so this is not the first time, though, that we've heard from a company about AI leading to layoffs. We've heard from Amazon, we've heard from Block, we've heard from so many other players over the course of really from the fall until now, all about reinvesting, taking this workforce and reinvesting back into areas that they think that AI could be used to further boost productivity. And I know that with the Fed meeting this week, that will also be a key question area as well, is how has AI led to more productivity gains? And after this note from Citi, it's pretty apparent that Meta, big tech, and other players are seeing a boost in momentum there as well.
Not to be a jerk, Dan, but isn't this an amazing moment for some of these big companies? They're seeing accelerated top lines because of all things AI, and they get to fire people in thousands to free up free cash flow, to improve their margins. I mean, this is a perfect investment case, no?
Yeah, but Taz, I also think like some of this is probably the bark's gonna be worse than the bite. When it comes to layoffs, you also look at how many that they've actually hired, over the last, call it 3-4 years. Look, I think it's a balance because this is an arms race, and the reality is when it comes to engineers and it comes to developers on the software side, it's a balancing act. But it does speak to the point, like we're in year 3 of an 8 to 10 year build out of the AI revolution. And that's why it's our view, like I get the white knuckle moment, everything we're going through geopolitically. I think tech makes new all-time highs this year. And I think that speaks to our view, like software continues to be way dislocated. And the AI ghost trade is going to be viewed as an opportunity to own the winners.
Dan, the Mag 7 has underperformed the S&P 500, at least prior to GTC. But like I just mentioned, these software stocks have come back. Where would you like to go? If you've been raising cash and you want to get back into some of these names, is it Mag 7 or is it software? I was thinking ahead of the show what I talked to Okta co-founder and CEO Tom McKinnon yesterday, and he really made a good case, or he just proved to me that his company, software, cybersecurity, they are reinventing themselves for the case of AI, and they have the orders to prove that what they're working on, companies actually want and they're willing to pay for.
Look, so I think that the thing is, look, Anthropic is part of that ghost trade where, in terms of taking over software, taking over cybersecurity, better chance of me playing, 2028 Olympics than that happening.
You're going to the Olympics, Dan. You're going to the
Now,
Olympics.
again, you've never seen, on the track. But the point is, if you look, I think it's cybersecurity, that's front and center. CrowdStrike, Palo Alto, Checkpoint. You look at software, I continue to think ServiceNow, Salesforce, way oversold relative to what I think the opportunity are. And I think we're going to look at that Anthropic event from like 3 weeks ago when they introduced the AI agents. That will be viewed as the bottoming in the software trade.
And as I tip my hat to Jensen Huang, not because he looked great again on stage, he had a lot of cool technical things to show, because he took the attention away from the Federal Reserve meeting. And it could be a challenging meeting for Fed Chair Jerome Powell. He has to acknowledge in his press conference after the decision what is happening with oil prices and inflation. It seems like a lose-lose scenario for him.
Yeah, he has to acknowledge that oil prices could be here at these levels for a while if there's no end in sight. I mean, the duration of what's going on in the Middle East is what's really going to determine these oil prices. It seems to be that there are some vessels that are going through the Strait of Hormuz, that it's sort of a selective process where Iran is letting some go through, others not. But certainly, when the presser goes on tomorrow, he is going to be peppered with questions about the impact of rising prices on rising oil prices on inflation and how that is going to shape what the Fed does this year. And increasingly, Wall Street is expecting cuts to be later, perhaps this year, and because of these rising prices.
Brooke, I can't wait for the next consumer confidence report. I think it's going to be so telling. We saw in the most recent one that these higher prices just a couple weeks after the war have already started to impact consumers. We get the Macy's earnings out, I believe, tomorrow too. It's not looking good for the consumer this spring, at least off the jump.
Yeah, Brian, it's definitely not good. What we heard in the consumer sentiment report just out last Friday morning, that was preliminary data. The final report will be out later this month. But we're already seeing that impact of this war with Iran on the way that Americans feel about the economy, particularly the impact that higher gas prices have about their ability to go and spend. And so many sources that I've been speaking with over the past few days have largely told me that the first thing to go, similar to what we have been seeing, is that discretionary spending. And that could mean bad news for players like Macy's potentially, or players like Nike, Dick's Sporting Goods, sporting goods in general, apparel, toys, anything that are like nice to have but not need to have. And this will just reaffirm more consumers focusing in on those essential goods, and essentially that all swings back to maybe Walmart continuing to do well as well.
Dan, last word to you. You're a big robot guy. We heard Jensen talking about robots. And I'm seeing so many aggressive growth projections for humanoid robots. I mean, are you going to have one in your house? I think Inez and Brooke may get one. Maybe I will get one eventually. But are you big on these things? And are all these robots going to be powered by Nvidia chips?
I think humanoid robots, I think I'll have one probably in the next 2-3 years. I think you're going to have one too, Saz. I've told you that. Like, I think this is, when you think about what's happening in physical AI, robotics, autonomous, it's the next frontier. But it speaks to Nvidia. Tesla, I think, continues to be the best physical AI play along with Nvidia out there. And this is coming. We're going much more to, the Jetsons and the Flintstone stage.
Love to hear. And Dan, I will just say this, in the 2028 Olympics, if they have a stock picking contest, you, my friend, would get that gold medal. A big thanks to Dan, Brooke, and Inez. We'll talk to you guys soon. Coming up, the Property Brothers, Drew and Jonathan Scott, pop on by for a chat on the challenged U.S. housing market. That's next in Opening Bid. The U.S. housing market is, for lack of better words, all over the map. Mortgage rates have come off the highs, but housing affordability remains a challenge for would-be buyers. That's if someone could actually go out there and find a home in the supply-short market. When I want to know anything about housing, I drop a line to the Property Brothers, Drew and Jonathan Scott. They have their pulse on all things housing, from hot markets to hot remodeling trends. They stopped by Yahoo Finance HQ earlier this morning for a chat with me.
You know, it's a time where Jonathan and I, you know, our faces are fading fast, so we're like, get as many shows under our belt as possible. Yeah. So what we've done over 1,000 renovations. We've done, 650 episodes of our shows. But Property Brothers Under Pressure is a whole other level because it's so relatable. The housing crisis and the pressure everyone is under when it comes to finding a home that actually works for your family.
And we're kind of showing it almost doc style, where a lot of the stuff that used to happen off camera, behind the scenes, we're just showing it. You see everything. You see the crew, you see like last minute, butting of heads, you see everything.
And the stories as well. See, I get emotional when I talk about it.
I see it.
The stories are so impactful as well and emotionally connecting for the audience too, because there's a lot of things you can relate to. For example, our first episode is a family that lost everything in the fires in LA, in the Eaton fire. And so this is them trying to build back their lives. They literally lost everything of theirs from their home. We have other families that can't afford to live where they work, and so family members have moved together with their kids to have two families in one house to try and be able to afford where they want to be. Every story is very, very unique, but I love it because it's so relatable.
I'm glad you mentioned the housing affordability. I live in Long Island, and there was a house, a tiny house that just sold for $330,000. It has no rooms. It is, as you walk in, it's just this blob of a thing. I mean, that's what we're looking here. That's a real crisis.
And I wish people would take it more seriously, because every time, we're talking about affordability, we're talking about the housing shortage, and then a year later, we're talking about it again, except the stats have gotten worse. Mm-hmm. And so people need to start figuring out, at the government level, we need to figure out financing programs that incentivize people to build affordable housing. And then at the everyday level, people need to understand affordable housing is good for the city. We need it, but the NIMBYs are the ones who block a lot of it and say, I don't want another, apartment building, or I don't want to have low-income housing. They don't understand that low income does not mean that it's, it's drugs and, crime and things. It's nurses and teachers and police officers. It's all this in a space where they can live and work in the same community.
And you look at, the stats, I think that I saw, sorry, I'm getting my allergies or something. Excuse me. But the stats are saying like this is, in modern history, this is the worst for affordable housing. This is the worst it's ever been for first-time home buyers. And you see first-time buyers are 25% or less of purchases right now. So it's
I saw a stat that was crazy. It said that the new median age in America for a first-time buyer, it's not first time.
It's 55.
55.
Really?
It's 56.
That's
It said the
crazy.
new median age for the average buyer, not first-time buyer, but the average buyer is 56. Like, that is crazy.
That is crazy. We hear so many different roadblocks that the houses cost too much, there's not enough supply. You mentioned some of the challenges from the government perspective. What is the biggest challenge? Is it the government roadblocks?
Supply is the biggest problem.
So supply, and then the reason for supply is a number of things. Even there's another stat that was saying that there are so many. I can't remember what the surplus is, but there's so many houses in the country that the government keeps saying, okay, well, here's how many houses we have, but a huge portion of that is people who own second and third homes, and they just leave these extra houses empty or these apartments empty.
They got to sell these things.
It's fine if somebody has the means and wants to have something else, but that shouldn't come out of the inventory that we need. We're about 4 million houses short in the country from a healthy supply of houses.
Yeah, and you look at the, every time I'm going to talk, I'm going to clear my voice just for you guys.
We can do AI him out now. We don't even need him.
All right, let's AI him back in here.
Yeah, so more people are renovating right now because they can't afford to get a new place. They couldn't even afford to sell their house and find something new. And so, the renovations have gone up. I think it's up 30 or 40% or more. However, with people with their properties that they're owning, I think that the hardest thing, the supply side, rates don't matter. Rates have come down, which is great. It makes people excited to buy. But if you have no supply, the rate change doesn't make that big a difference. So we need to solve some of these issues, building more density. The government side of it, if we have the process for getting your permits and getting things in place is a little bit easier. Incentives for developers to do affordable housing is a huge thing. We come from Canada, great incentives up in Canada that really help developers dive in. Here, we don't have any of that.
And also, I think something that would be great is everyone's so scared of AI and what AI is going to do. If AI could shorten the permit timeline, That alone would
seems
make
logical.
AI worth it.
Yeah. It could do everything else.
If everyone wants to join me on my crusade to work with the utilities and the cities to reduce the weight on all of those services, there are so many projects where I have the project either ready to go and we're waiting for 6 months or 8 months or even a year just on permits, or the only exception actually was rebuilding my fiance's family home in the Palisades that burned. My permit was approved in less than 3 weeks. They're so focused on making sure they can help people build back that they've created pop-up permit offices. But everywhere else, it's either the utilities or it's the cities that are delaying these for no real reason.
So if I'm 55 and I want to buy my first house today, what advice would you give me? I'm not 55, to be clear.
I was going to say, you look
I'm not
great.
55. I do look great. But
Yeah, no, I mean, so it's tough. Again, on Property Brothers Under Pressure, you see this as well. People are finding creative ways to get into home ownership that they never thought they could get into before. But I think the main thing is understanding what your needs are if you need to be in a certain area. The tough thing for a lot of families is if they have to be in LA or New York because of family or whatever reason, their job, that's the tough thing. If there are other people that could float and be somewhere else, then go somewhere that's a bit more affordable that you can get more bang for your buck and it helps. I know we're leaning in on the government side to try and see what we can do. You know, we own a modular company for building homes, and that's one way to bring the price point down. But the thing I find very annoying is there are a lot of people out there, even after the fires in LA or just in general with affordability, they're taking advantage of homeowners. For example, when the Inflation Reduction Act came in, it had a whole bunch of incentives to help families create a healthier home environment, electrify their home. But a lot of the service providers, or like HVAC providers, for example, they were just upping their prices by what the difference of the rebate was, and therefore there's no benefit to the homeowner. It just all goes to the manufacturers or the service people.
So I should not buy that overpriced tiny home.
That $300,000 one-room house, not a good investment.
You can move in with us.
But I appreciate that. What mistakes are you still seeing people make?
So right now, it is very important that people make smart financial decisions when they're buying or renovating a home. And some people will get so emotionally charged that they'll run in a direction, they'll do something that they're never going to recoup that money if they have to sell. I always say there's two types of renovations that you do. There's renovations that will actually increase the value of a home and you will get more money for that thing that you put in when you sell. There's other stuff that it may help you sell, people really like it, it looks pretty, but you're not getting any more money.
Yeah, I would say don't over leverage. There's still a lot of people that are putting themselves a bit too thin. If you're looking at getting a place, you know, a lot of people are going from a house into a condo because they can't afford a house. But in reality, if you can get a house with a rental suite, the money generated from the rental suite should be able to offset more than what you'll end up paying with your condo along with your HOA fees and everything else. So look for a creative solution like that. Or is there somebody that you could live with? Is there somebody that you can get into a place where you each have your own suite?
I'm not moving back in with my mom. I can't do it, guys. Like it has not come to that. Oh my God, Jesus, no way.
Give it time.
No. So what? You know, if you look at forward here, like what are the biggest trends you're seeing in the renovation market? You know, last time we talked, you were talking about how we're going to have to remodel our homes at some point because of the baby boomers. We're going to have to add railings in various parts of our home. Is there something else you guys are seeing now, if we do in fact get a home?
I mean, the big thing I'm seeing mostly is people want specialty rooms at home. So instead of having to get a gym membership and go to a gym all the time, they want to have a home gym or a Zen zone or a sports facility, a cold plunge. Yeah. So we're seeing all of these requests for spaces that used to be a spa or a gym or somewhere else. People are including those at home. Even
because people don't want to be spending, their monthly expenses are crazy. It's through the roof. That's one of the biggest issues as well right now when it comes to people living somewhere is they can't afford the monthly payments. So if you can streamline any of that to have the enjoyable life, the entertainment side of it at home, great. But also we're seeing a lot of people who are getting a place where they'll get a 2-bedroom home but add a 3rd bedroom. In fact, we have that in one of our episodes as well. We created a bedroom for the kids because they were cramped in their home. So I think of what's important to you and what you're looking at. I know you don't want to live with mom.
No, hell no.
But what else would you squeeze into your house?
I like the Zen room.
Yeah.
I like the Zen room. Ideally, I walk in, there's a cold plunge, a sauna, and I don't know, maybe a bunch of Sonos speakers.
In your kitchen? You want it all in one spot?
Yeah, just all in one spot.
I want to sit on the toilet, a smart toilet,
yes.
with my sauna right there.
We're not going there, guys.
Yeah.
We're not going there. Since we last spoke, I think you are now on a Canadian hockey team? How is that like different than what you do? How do you renovate a hockey team?
Yeah, right, exactly. I mean, it's business is business in many ways, but it is very different. It's the Vancouver Giants. They're a major junior team in the CHL, in the Western Hockey League. And Michael Bublé and I are owners. He got me into that. We're both from Vancouver, and it's sort of supporting our hometown. We love it. I mean, it's I've always been passionate. Jonathan would make fun of me over the years. I'm just such a sport nut, and so to now be a part of owning a franchise is so exciting for me. And these kids, they're one level below pro. I mean, some of them, they're gonna, 2 of our kids are probably going to go top 10 in the NHL draft this year.
Wow.
And they're all teenagers. It's just crazy to me to see the talent level that is at that.
I saw a post on X recently, lastly, that they might want to bring back the Expos. I mean, who doesn't love the Montreal Expos?
I mean, come on, why not?
Maybe you get involved with that.
You know what I want? I want them to bring back we won't be bringing back the Grizzlies, but I want an NBA team in Vancouver as well. So that's I'll rally for that. We'll get basketball back there.
All right, well, good to see you guys as always. Thanks for always making time for me, and good luck on the new show. Love the name, love what you guys are doing. I love that you're just not like renovating homes, you're taking people through the buying process.
You know what I love?
Because this stuff is hard, man.
I love Mom. Say hi to Mom.
No.
She got hit hard in this interview.
I really
I think
her.
Mom's great.
She always watches. She already likes you guys. You don't have to do that, all right? Good to see you guys. I appreciate
Nice to see
it.
you,
Thank
yeah.
you. Thank you.
Welcome to Market Catalyst. I'm Julie Hyman, 30 minutes into the U.S. trading day. So let's take a look at the major averages here as we stand on this Tuesday. There we go. We've got the Dow up about 350 points today, about 0.75%. The S&P 500 up about 0.7, and the NASDAQ Composite up about 0.75% as well. As we know, the markets have really been taking their cue from oil prices. Today, oil is up, but stocks are also up. So it's an interesting phenomenon compared to what we've been seeing. That said, oil has obviously come way down from the most extreme levels of $100 and more, where we have seen it touch over the past couple of weeks. Right now, it's up about 2%. And if we look at what is moving stocks around today, take a look at the sectors within the S&P 500. This is a 1 month, so we're going to switch it on over to today. Energy stocks are helping lead the gain. So there we are seeing that the higher oil prices are benefiting one group, but it's a broad-based rally today. It's not just energy pulling us higher. Financials are catching a bid today, up 1.25%. Consumer discretionary and communication services are rising as well in today's session. And it's interesting to see those banks do a little bit better today, because financials has been one of the worst performing groups. Here's a heat map of what's going on with the banks today. A lot of them bouncing back here. So again, interesting to see this kind of activity. But going back to something else that we are watching closely that's definitely having an effect on the markets, and that's Nvidia's GTC conference yesterday. What's interesting here from this heat map is that most of the NASDAQ 100 is in the green today. Nvidia was in the green yesterday, but not by much, just about 1.5%. Today, the shares are little changed after its highly anticipated GTC conference. It rolled out a number of products, product updates, and also a very large number, $1 trillion. That's what CEO Jensen Huang says the company is going to generate in revenue from its AI chips between 2025 and 2027. So let's dig more into that specifically. Joining us to talk about it, Ivana Delevska, Spear Invest founder and CIO, and Gil Luria, D.A. Davidson, head of technology research. It's good to see both of you guys. And, you know, there were a lot of product announcements, but I want to start with the number, which is $1 trillion, as I mentioned. Actually, Ivana, looking through some of the analyst commentary, it seems as though $1 trillion is not that much above what the sort of estimates were out there for what the company was going to generate from this. Is that why maybe that number didn't spark more enthusiasm?
Well, thanks for having me, Julie. I think the big thing for people to understand is that the $1 trillion is not their revenue projection or the final number for 26 and 27. That's just what they have in backlog so far. So when you look at the current revenue projections and compare it against the $1 trillion, it's really not a big surprise. But if this is just a starting point with further upside, I think that once people realize that, that's going to drive further upside for the stock.
Is it, Gil? What do you think? I mean, you know, you would think that it would, but it's been awfully hard to move those Nvidia shares.
Yeah, I think it doesn't matter how high of a number Jensen Huang said yesterday. The market is just not willing to believe that the great data center build out will continue into next year. The market is very much indicating that it thinks as a collective that this is peak CapEx investment. And so the fact that Jensen Huang is guiding for it not to be, for more than 30% growth next year, is really falling on deaf ears right now. He's pushing rope. Now, having said that, soon enough, Microsoft's going to show up on their July earnings, and they're going to guide for their next fiscal year, which goes through June 2027. If they start guiding for further increases to CapEx into next year, and then Amazon and Google do that later on in the year, I think investors will start believing it more. But right now, it doesn't matter how far in the future and how big the number that NVIDIA is guiding to, the market's just not willing to believe that we can continue to build data centers at this rate.
Yeah, it's an interesting belief, and one I think Jensen Huang, of course, would probably push back pretty heavily against. Ivana, you're there at GTC, so you were there as we were getting Jensen rolling out some of these other announcements. I mean, the number probably gets the big headline, but it's really a product conference when all is said and done. And I'm curious, being there, what do you feel like is the most exciting, or what is the most buzz around as you talk to people there?
Well, I think there are two things, right? On one hand, you have a lot of new chip announcements as part of the Vera family. I think what we're moving towards is each specific application is going to be optimized on a specific chip. So that was pretty interesting. And then the second thing is the implications that this has for the value chain. I think that's where really we're seeing a lot of the upside. We're going to be at another conference today, OTC, for optical components. We think that the components are really going to drive the next leg of improvement. whether it's NVIDIA components or some of the competitors, I think companies will be able to choose. But that's where we're really seeing a lot of the big upside numbers for this year versus NVIDIA, which we believe is going to be more of a compounding story.
Well, just to follow up on that, Ivana, it's interesting because we are seeing, for example, shares of Coherent and Lumentum pull back a little bit today because we heard some commentary from Jensen about that copper is still going to be important, right? And those are more optical components providers. Do you think it's going to be sort of an all of the above approach, though, that the demand is so great that like everything in the supply chain is going to win? Or do you think that investors need to be focused on certain areas?
So we like both copper and electrical. As you look forward into the next 4 to 5 years, we believe copper will really lead in the next 2 to 3 years, and optical components will gain traction further out. That being said, you want to invest in those today. So we have exposure to both, and we're positioned to benefit from both of those trends. But I think it's a mistake for people to go overweight one or the other, because I think both of them will benefit.
And Gil, as we talk about the interconnectedness of all of this, right? Something else that strikes me as I look at some of the products that NVIDIA is talking about, whether it's NemoClaw or it's now LPUs, language processing units, is again this maybe quest, whether it's probably I was going to say implicit or explicit. It is explicit, to try and get its clients very reliant on its full system, right? And so I'm curious what you think of that strategy and how much what we heard yesterday sort of again contributes to that.
Yeah, I think that's exactly right. Up until now, really, NVIDIA's had a very GPU-centric focus. They're more of a one-size-fits-all. And now, to build on what Ivana was saying, they're saying, no, there's multiple paths forward. We could use copper, we could use co-packaged optical, more variations on the software. And importantly, I'd say the most important takeaway from yesterday is around the introduction of the Grok technology into the system. So now, with Grok integrated into the NVIDIA systems, their ability to do inference and do it inexpensively and at a very rapid pace extends their lead over Broadcom and AMD. There was some concern that AMD is becoming more competitive and there were custom GPUs and there's the Broadcom ASICs. And what NVIDIA is doing is now extending its range to say, we're not just GPUs that are very good for training. We can do inference better than anybody. And Grok was really critical to that. And that's what they introduced yesterday, was how much more effective they're going to be at inference because of the integration of Grok technology.
Gil, do we know what the margin profile of those kinds of products look like versus the GPUs?
Well, NVIDIA's been able to keep its margins in the mid-70s throughout this cycle, with manufacturing delays, with implementation delays, with new product sets. They have all the pricing power, and that means that they're likely to be able to hang on to those level of margins, especially as we are in the aggressive part of the build-out.
Ivana, I want to go back to something that Gil was talking about this belief by the market that we're at peak spend in terms of CapEx. And I'm curious what you think of that and whether you agree that we still need, or the market needs, whether you guys believe it is one thing, whether the market believes it is another thing, and what kind of proof points might be necessary.
Well, I think Gil was spot on in that we do need to see further CapEx increases from the hyperscalers. That's really the key number to watch, because they're over 50% of NVIDIA's business. So really, that's the one data point to focus on. But I think the numbers are the numbers. So if you get to 27 and NVIDIA is putting up $15 in EPS, there is no way the stock can stay at this level. So these companies very rarely trade below 10 times PE. And we believe once people see the numbers, there is really going to be no way not to drive the stock higher.
Gil, just sort of more broadly, it's not just obviously in the infrastructure builders like an Nvidia that have been sort of sideways, right? Although sideways is the best case. A lot of companies in the AI stack have been down. we've talked about this a little bit before, and especially now that there's so much noise from the war, for example, in Iran. What do you think is going to kind of change the narrative, if any? And do you think that's coming anytime soon?
The more we use AI, the more it becomes compelling at the consumer level, at the enterprise level. The more pre-sold these data centers are going to be, the more the big data center companies, Microsoft, Amazon, Google, Meta, will continue to build them out. And it's going to be a self-fulfilling prophecy. And we had breakthroughs with ChatGPT, and ChatGPT got a lot better. And now we've had breakthroughs with Claude and Opus and their ability to help us with coding and create tools at work, which are creating incredible demand for compute, which is precisely why these companies are building so much. So as that virtuous cycle continues, investors will start getting comfortable that that's the new normal, that we are going to incorporate a lot more of our economy through AI, and therefore we do need this compute. And that's going to result in these companies outperforming. And to Ivana's point, Nvidia is trading at a market multiple. It's going to grow 60, 70% this year, 30, 40% next year. That's not going to last. As long as they continue to grow at these rates, at some point, the multiple is not going to contract anymore, and they'll be able to outperform. And the same is true for companies like Microsoft, also trading at close to a market multiple with very predictable mid to high teens revenue and earnings growth. Those are artificially deflated multiples because of these concerns about next year. The closer we get into next year, the more people are using AI, the more confidence they're going to be in a continued data center build out. That's when these stocks outperform.
All right, we shall see. Ivana Gill, thank you so much. Appreciate it. Coming up, a fresh wave of attacks sending oil prices higher. We'll talk about the outlook for the oil markets and for oil stocks next. Oil prices on the rise after Iran launched attacks on UAE energy facilities, fueling concerns about further supply disruptions. Joining me now, Fernando Valle, Hedgeye Risk Management Energy Analyst. Fernando, it's good to see you. Obviously, there is a lot to parse through in terms of the headlines, but bottom line, it does not seem like supply constraints created by the Iran war are going to be easing anytime soon.
Absolutely, Julie. It's great to be here, first of all, but it's going to be a long-lasting effect, even if the war stopped tomorrow. There are impacts that are already underway that can't be easily reversed. And not just on oil, but natural gas, fertilizer, all the main commodities that come out of the Middle East. These disruptions are causing some producers to shut in capacity. And it's not as easy as flipping a switch to produce oil again. It will have impacts subsurface that could have much longer term ramifications on the production. And then to just get it back into full capacity could be weeks, if not months. Remember, some of these areas, especially Iraq, have less than ideal infrastructure. And they're still very significant in terms of production. Iraq is over 4 million barrels a day, which is just about 4% of global production. So the impacts are going to be last longer than just the conflict itself.
So just to put a fine point on this, Fernando, okay, let's say tomorrow somehow the two sides say, okay, we're going to stop fighting, or three sides, I guess, if you count Israel in this as well. They say we're going to stop. And Iran says we're not going to prevent ships from going through the strait, or we're not going to attack them anymore. How long does it take then for the oil market to normalize? And I guess two questions, because it's really about how much does it take for the supplies to normalize and then the prices to normalize, which is sort of two different questions.
The price will have a first leg that will be fairly quick because the cost of shipping will come down sharply. Once you get the insurance side of the equation fixed, then you get the more security through the region. But the longer term impact, we're talking about several months for now, at least 1 to 3 months if it ended tomorrow. But the longer the conflict goes on, the longer it will take to normalize, because what you're seeing as contingency measures are releases of strategic petroleum reserves in the US, in Europe, in China. Those are just an exchange, right? You're putting more barrels out today, and eventually you're going to want to refill those reserves. So that will keep prices higher for longer than they would have had otherwise. The second aspect of this is what I mentioned, the shut-in of the production. The longer it's shut in for, the slower you have to ramp up that production. Oil it can be very delicate. You're trying to balance several elements below surface, and the longer that well is shut in, the more you have to worry about the degradation of the equipment, of the degradation of the reservoir, and bring it slowly to make sure that you are producing in a sustainable way. So today I would say probably 2 to 3 months to normalize, but the longer it goes on, the longer it will take.
So, Fernando, let's talk about what investors should do with all of this information, right? Because we've already seen energy stocks have just been ripping higher, even before this war began. And now the XLE, the biggest energy stock ETF, is up more than 30% just this year. So I know there's sort of a debate about how much further it could go up. What do you think? Do you think that most of the gains are behind us now?
I think there's still gains to be had. We have been advising for folks to go onto higher leverage, the marginal suppliers, so small caps, mid caps, but that have inventory room. So we like Matador, for example, ticker MTDR. And we think there are still some gains left. We are always going to look at how the fundamentals are moving and also the flows are moving within the broader market. The biggest fear we have here is not that it normalizes tomorrow or the conflict ends tomorrow, as I said, but is that as oil prices remain above $100, as fertilizer production also costs get higher, the consumer itself will get squeezed, and that will lead to demand destruction. That's likely a couple months out, but that is a serious concern that we have and something that we watch. And we'll keep tracking it so that when it's time to get out of these stocks, because as we've seen with the consumers, and you can look at the retail sector as an example, there isn't a lot of spare income there to deal with a long-lasting $100 plus oil price, widening crack spreads, widening costs for food as well. So those are our biggest concerns, but we think that that's not in the immediate term.
So that's interesting. So it's not as though you're saying a company like Matador is immune to that. It's just a matter of maybe it still has a little more upside before that happens. Is that sort of the calculus you would make on any of the energy stocks you're looking at right now?
Yeah, I think for the sector, broadly speaking, if we stayed sustainably above $100 a barrel here, and natural gas prices also elevated globally, and then food prices elevated, then yeah, we would be concerned about demand destruction in the second half of the year.
And then before I let you go, I want to get one more pick in, and that's Petrobras, the Brazilian oil giant. Why look there and not to say the U.S. majors?
Well, two big reasons for Petrobras. The first one, it's Brent based because it sells most of its production offshore. Brent is currently at 102 versus WTI at 95, $7 spread there. You're making more money that way. It's also more oil heavy than most of the Permian names today. And then Brazil, because it is a big exporter and can be a substitute for some of what is lost in abroad, it can benefit from the FX as well. The big concern we have is exactly that what I mentioned earlier, is that diesel prices being as high as they are going to hit emerging markets harder. How much a average Brazilian spends on fuel is significantly higher percentage of their income than for an American. And we're already seeing some of that stress, especially on diesel prices in Brazil, something that could ultimately affect Petrobras' ability to capture all of the gains. But in the immediate term, again, the benefits of being a Brent-based, low-cost supply, mostly oil producer, outweigh it for Petrobras.
Fernando, thanks very much. Appreciate it.
Pleasure.
Coming up, the top analyst calls on Wall Street and a look at some of today's trending tickers. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke Tamama. We're live at the NASDAQ here in Times Square today. Let's break down some of today's top analyst calls on Wall Street. Today we're watching shares of Eli Lilly, Coinbase, as well as DraftKings. First up, let's take a look at Eli Lilly. HSBC cutting its rating on the stock to a sell equivalent from hold. The analyst thinks the drug maker might not deliver on the street's expectations of $1.5 billion for its oral obesity pills in 2026. We've been hearing a lot about these pills year to date. He went on to say that while the execution has been good, the bullish view is already embedded in the stock, making it unattractive. There are still 32 buy ratings, 5 holds, and 1 sell, so still mostly bullish on the street. Next up, let's take a look at Coinbase. Baird cut its price target on the stock from $215 to $165. The analyst says that recent crypto price appreciation and stablecoin tailwinds are being somewhat offset by weak exchange trading volume so far this quarter through early March. Still, the analyst says that higher tax refunds could boost crypto deposits. We'll look out for that, but there are still 25 buy ratings, 11 holds, and 5 sells. Last up, let's take a look at DraftKings. We've been talking a lot about it in March Madness. Argus downgraded the stock to hold from buy, citing aggressive competition from, you got it, prediction markets. Plus, the analyst says that the downgrade also reflects higher customer acquisition costs and increased state taxes. The street, though, still mostly bullish on this one, too. There are 28 buys, 10 holds, and no sells on the street. And that's about it. Keep right here on Yahoo Finance because we'll be tracking all the latest market moves and top calls throughout the session.
It is time for some of today's trending tickers. We're taking a look at airlines, Delta and American specifically, Uber and Oklo. Markets and data editor Jared Blick rejoins me now. We were just debating the pronunciation is indeed Oklo.
You know, that's the hardest part of this job.
Is figuring out how to say things,
Yes.
how to say words correctly.
Biotech. All right, we got to move on.
Delta and American Airlines. I know how to say those. They're both forecasting strong bookings for the spring. Now, this is perhaps surprising, right?
Yes.
Because we've got higher oil prices, aka what translates into higher jet fuel prices. We've got the TSA. What look like sick outs because of not having funding.
Right.
And yet these guys are saying bookings are strong.
That is the case with both of them, and Delta is doing a little bit better. Their margins are better. So I'll go through the demand picture here. So Delta said consumer and corporate demand accelerated in March. So they raised their Q1 revenue growth to high single digits, so from 5 to 7%. They kept their quarter one EPS guidance 50 to 90 cents, and that's very significant because that's even after all of this fuel pressure. And Delta also said they had 8 of their 10 highest sales days ever this quarter. So then you have American, which is pretty much the same demand story, but weaker quality of update. Why is that? We'll get into that. They raised their Q1 revenue growth to more than 10%, so it's from 7 to 10%, which it called the strongest year-over-year quarterly revenue growth in the company history outside of the pandemic recovery period. But now jet fuel is assumed to be $2.75 a gallon, pushing adjusted loss per share towards the low end of its prior -10 to -50 cent range. So still expecting a little bit of a loss there, but considering these fuel hikes, that's still kind of remarkable.
Yeah, I mean, and I guess bookings and revenue are better, but margins are still going to get squeezed, I guess, is the bottom line for all this. And
if we go to the Wi-Fi Interactive, I'll just give you the transportation space heat map real quickly here. And there's Uber in the upper left. We're going to talk about them in a second. But here's Delta. It's up almost 4%. And then American is up about 2%. But here are that's year to date. Let's do month-to-date losses here. And you can see pretty red board. United's down 13. American is down 18%. And then if you take a look at the year to date, well, the airlines are actually the worst off, and here's American sitting at the bottom at 30%. So it had a rough go of it, and especially getting hit because of all the fuel surcharge or the fuel charge worries. But given the news today, I would have expected them to pop a little bit more, but maybe we'll wait for earnings.
Maybe those margins are holding them back. Let's stick with the transports. Yes. We already gave a little tease because you showed the heat map. Uber's what we're talking about. It's going to roll out its Nvidia-powered autonomous vehicles in 2027. We already knew the two were partnering on autonomous vehicles. This is a little bit of an expansion of the partnership, more of a timeline for the partnership here. And Uber shares ironically, they're reacting more to all of this than Nvidia shares are.
Yes, and why not? Well, Uber is really beefing up their push into autonomous vehicles, so they're going to be the platform for everybody else's AVs, apparently. They've got deals now with Zoox, Wave, which is Nissan, now Nvidia. Reuters did the math. They said they got 25 autonomous vehicle tech firms signed up here, and they want driverless rides in 15 cities by the end of 2026. I don't know if New York is on that list. I don't know if we're ready for that, but maybe.
I'm ready.
Okay, Julie's ready.
Bring it on, please.
So these robo-taxis, Uber and Nvidia saying these robo-taxis on Uber would start in Los Angeles and San Francisco in 2027 and expand to 28 cities by 2028. And so now we got a rollout match, and Uber's kind of come alive recently. If we can go to the Wi-Fi Interactive, I'll chart it real quickly. Here's today, us up 5%. Here's year to date. You can see it's climbing off of these February lows. So it's done pretty well considering everything that's happened with the price of fuel and other things. There were all kinds of disruptions in transportation for various reasons. But let's go back to the very beginning here, the IPO and just before the pandemic. And you can see pretty much in a trend line, might have broken that, but pretty much in a trend line to the upper right since 2023.
All right, let's talk about one more, and that is Oklo. Oklo shares are popping here. The company signed an agreement with the Department of Energy to support construction of Oklo's first nuclear reactor. Now, Oklo is a nuclear reactor developer. It is working on developing small modular reactors, not like the big ones that are in use today, but it hasn't built one yet. It's working on building one to demo, not to actually be. It's a very long process, as it probably should be, to develop new nuclear.
Yes. And so this is a pre-revenue company.
Yes.
And now they have their first NRC license for Atomic Alchemy. Atomic Alchemy was a business that they acquired previously. They have new DOE approval for the nuclear safety design agreement of the Aurora powerhouse at Idaho National Laboratory. So there are a couple of things falling into place here, but there's a very long roadmap.
Yes.
And the regulatory process is probably the biggest one there. Nevertheless, we talked about this on this show. Meta struck an agreement in January with them supporting 1.2 gigawatts of Oklo nuclear power development. That's in southern Ohio. So all these things kind of add to credibility, but this is a stock that's kind of, trading on pre-revenue vibes right now.
Yes.
So if we go to the Wi-Fi Interactive, it's up 3.5% today or so. And I'll just put a max chart on there. This goes back to almost the beginning of the pandemic. And you saw all that hype that kind of surfaced in 2025. And then over the last year, you can see that peak there in October. Over the last 6 months, there we go, down about 35%.
Yeah.
So,
one caveat with the max chart,
Yes.
it was a de-SPAC, I believe.
Okay.
That's how they came public. So
might have had some prior history there.
Yeah, exactly. So you had it trading at 10, and then popped up once they actually made the acquisition. But I mean, it's such an interesting time for nuclear right now because the administration is very supportive of it. Yes. But the technology and the safety profile of this stuff is not quite fully baked as of yet. We're waiting.
Not seemingly.
Not seemingly. We'll see if it gets to be a post-revenue company.
Yeah.
Jared, thank you so much. Appreciate it. Coming up, companies ditching their CEOs at record levels. What's behind all those C-suite shakeups? We'll hear about that next on Market Catalysts. The CEO turnover trend continues in 2026 after hitting a new record last year. Adobe C-suite shakeup, just the latest among the growing list of companies announcing a new leader at the helm. And Yahoo Finance's Josh Lipton talked to Bill George, Harvard University Executive Education Fellow and former Medtronic CEO.
You know, we mentioned Adobe there, Bill, in the intro. Maybe start there because CEO Shantanu Narayan will be stepping down from that position. Bill, that was a big headline when it dropped. Obviously, he has led that company a long time, nearly 20 years. A true just Silicon Valley legend. What did you make of that news, that headline, Bill?
I was a bit shocked by it. Shantanu is a fantastic leader. He's led that company, transformed it for the last 18 years. Just a year and a half ago, I went out and spent a day with him and his team, and things were going well. Okay, AI has come up very rapidly since then, but I put the blame on the boards of directors. So how can a guy be forced to step down after 18 years and not have a successor in place? And now the board's going to have to go out and look for a CEO. And that just creates great instability. You see the stock going down because of the uncertainty. And I think it's a very big failure on the part of the board of directors of Adobe and several of these other companies who are acting so precipitously to take CEOs and make changes. And I think that's why you've seen a big increase in the number of CEOs moving out.
Who should take his place, Bill? I don't mean, listen, you don't not a specific name, but listen, if you were looking, right, if this was your job on the committee, I mean, what's the resume, the background, the experience? Should it be an insider, an outsider? What would you be looking for?
Okay, he's created a unique culture there. And I would have had somebody come up from within, and I would have insisted, if I'd been on the board, like the boards I've been on, I would have insisted we have a strong succession plan, that we knew the internal successors well. There's plenty of time to do it. And that one of them gets appointed. Maybe we have two candidates, as I thought Shantanu did. And one of those gets appointed, and we say they're ready to go. Now we're going into Never Never Land, not knowing who they're going to appoint. And they'll probably bring in some high-profile person. But the key is, will that person fit the unique Adobe culture? I've been out there and seen how it operates. You better fit the Adobe culture and not try to take them a different direction, or you'll have another CEO replacement in 2 to 3 years.
My buddy Patrick Moorhead, Bill, well-known, well-respected tech analyst, I saw him post on X when that headline dropped. He said, listen, get ready, because this will not be the last SaaS, software as a service CEO to step down here. I'm wondering how you think about that, if you agree with that. Just listen, given the intense AI disruption fears that we do see rocking the software sector.
I would say don't overreact. I mean, there are a lot of great software companies. The market's moving away from them, but that may be a temporary thing. We don't know. Are we going to move away from Mark Benioff of Salesforce? No. I think this overreaction is on the part of the market's part, and the board's responding to it. The boards don't have to respond to that. So I don't think we should move so quickly. I think we need to think through, for these software companies, what is their future business model, and where does that fit in to the emerging AI space? Clearly, they have to do that. They've been warned about it. They see it coming, and it's coming faster than anyone thought. But who knows if it'll take off that fast or not, where the companies will really be ready to apply all these AI tools they're being given by the Mag 7.
Bill, more broadly, if you were advising a CEO right now, and just given how much is going on, war with Iran, the AI disruption fears, so many questions, unpredictability, what would be kind of your advice, Bill, on how you sort of navigate all these headlines right now? And would that advice, Bill, listen, would it be different than the kind of advice you would have offered, 5 years ago or 10 years ago, Bill?
So I would say three things. One, to the CEO, which I have been talking to a lot of CEOs about that, really understand AI and think about it, not just, yes, you have to do the efficiency. Yes, you're going to have to cut a lot of jobs and figure out how you're going to restructure your organization in an AI world. That's number one. Number two, what new business models are you going to create to serve your customers better using AI? I think that's the big one that everyone's overlooking right now. And then third, how is the world scene, if you will, going to impact you? We've got a war going on in Iran that no one planned for, and that's having a huge impact on energy costs. You know that AI is going to be a huge user of electrical energy. All this is going to play together. So be very careful about the world scene right now, because we could go into recession. We could get into stagflation with higher interest rates, higher inflation, and job losses. So I'm very concerned about that. So I think you have to be careful about that, but not overreact too quickly. So those are the three things I'm advising CEOs to do.
Final question, Bill. You know, all these CEOs you talk to so regularly, you know, they all went through executive training to sort of, you know, help them prep for exactly times like this, how to navigate turbulent periods. In your opinion, and listen, you were, of course, a high-profile CEO yourself. Do you think executive training to get ready for moments like that, does that have to be sort of reconsidered, reimagined in any way, Bill?
Well, let me say, most of the CEOs that are new right now are far better trained to run the internal operations and know how to do that, and not nearly as well trained to know how to deal with external events. And that's where they're falling short, and that's where people are overreacting. It's not just AI, it's the economy, it's maybe an activist investor, as we've seen in a number of companies. Maybe it's a war in Iran, and what's the fallout impact on their specific company, not just the generic issue. But you see companies that do it well, like Walmart, carefully planned. Doug McMillon, fantastic CEO, one of the top 2 or 3 CEOs in the world today. Turn it over to John Furner, fully trained, ready to go. And I think John has worked with Doug long enough to know how he's going to deal with these external events. Same 2 years ago, we saw at Costco, when Craig Jelinek, who did an incredible job, turned it over to Ron Vakras, who's been there 40 years plus. And it's been very well. So the boards, they're doing well. I think the real issue we've got to hone in are the boards of directors of not doing their jobs. And we had very carefully planned successions on the boards I served on at Goldman Sachs, on ExxonMobil, and Mayo Clinic. And you see how well David Solomon's doing. You see how well Darren Woods is doing at Exxon. You see how well Gianrico Ferrugia is doing at Mayo, because it was carefully planned. They were insiders and everyone knew. You didn't have the risk of the outsider. And I think boards need to focus far less on quarterly earnings, where they can't do anything about it, and really focus on strategy. Where's the company going, and how could external events like AI, like a war, interject and interrupt those impacts? And then I would say, don't overreact to short-term changes. Your stock, like Adobe, was just way up, record increases for 17 and a half years, and now it hits hard times, and boom, they want to change. We'll see if they can bring in somebody as good as Shantanu.
Bill, as always, great to have you on the show. Thank you, sir.
Thank you very much. Great questions.
Coming up, the war in Iran is complicating the Fed's rate-cutting path. We'll talk about that next. The Federal Reserve begins its March meeting today as the ongoing war with Iran is throwing more uncertainty into its rate-cutting path. So let's talk about the rate picture, the economic picture with Andrew Sizarowski, Morgan Stanley Senior Fixed Income Portfolio Manager. He is here with me in the studio. So we're not looking for a cut tomorrow. We know this. However, what we do know is that maybe things are a lot more complicated now because of this war and because of higher oil prices. So how are you thinking about what all of this means?
Yeah, I think what the Iran war does for the Fed is it kind of delays, not denies, these rate cuts. So I think that obviously we know oil's been shooting up. We know that's going to feed into headline inflation. Ultimately, I think the Fed's going to look through that, but it's going to take them some time. They want to make sure that there's not kind of spill-on effects into the service sector, other parts of the goods sector. And I think a year from now, the Fed will be, the Fed will be cutting more than the market's pricing in. But I think in the short term, the Fed's just going to be sitting on their hands. It doesn't matter with a new Fed chair coming in, they're not going to be able to do anything about that.
What about the pressures on the growth side of the equation? In other words, higher oil prices aren't just a risk for inflation, they're a risk for growth potentially also. So then, if that's the case, does the Fed get stuck in a very tricky position?
Yeah, I think the Fed's already in a tough position because you have a labor market that's continuing to weaken. We've had actually 5 of the last 9 labor reports have actually been negative. So if the Fed was just to look at the labor market, they'd want to be lower than they are today on the Fed funds rate. If they're looking at the inflation side, we know that headline and core just came out 2.5, 2.4% above the Fed's 2% objective, but they'd want to be higher than they are today. But I think what this does is it's going to put more pressure on the low-end consumer. I think, as you mentioned, what this is going to mean for growth, the longer oil prices stay elevated, what we've seen historically is it has a negative impact on growth. Could it be 0.1, 0.2% of GDP? If this persists, yes, it could. And I think that's something that's just going to keep straining that low-end consumer. They're going to pull back on spending. And I think it's a little too soon to see that yet. But it's something, if we continue here at these oil prices, you're going to see that.
And then is there also a read-through we need to be thinking about for jobs as a result, right? If you get some economic weakness, is that we already are seeing what looks like a maybe weak but stable job market? So I don't know. How are you thinking about that part of the question?
The longer uncertainty persists, what we've seen is historically is, look, companies don't want to hire. We already had a labor market, as I mentioned, that was kind of slowing. And I think we were entering a stall speed. We were in this kind of low hire, low fire environment, or actually no hire, low fire environment the last 6 months. And so I think that this is just going to put more stress on companies. They're not going to want to hire they're going to wait. They want to wait and see. And I think that what we've seen, as far as publicly traded companies is you're seeing them kind of do more with less. And that's not just the war. That's certainly kind of AI and other things starting to come into play here. And so I think for the labor market, this just puts more pressure on it, which just means the Fed goes more later. I think that the longer this persists, the Fed's going to end up cutting more, not less from this.
Interesting. Okay, so let's talk about how all of this is manifested in the rates market. We've seen treasuries kind of now go flat for the year because rates have come higher, yields have come higher. Does that make sense to you? And given your longer term outlook, does it present an opportunity?
Yeah, I think that in the short term, look, oil prices rising, that's kind of moving front end rates, and that's taking cuts off the table for 26. But I think the bond market, needs to be focused more than just the next 9 months, at the next kind of 18, 24 months. And I think this is creating opportunity. As you said, rates backed up 35, 40 basis points to start March. And I think that this is, if you have a long-term view and not just the next couple weeks, this is a great opportunity. We're getting more yield. We're also getting more spread too, because in addition to kind of base treasury yields rising, we've seen high yield spreads widen 50, 60 basis points. And so I think that's something that spreads were quite tight before, and they were getting kind of uncomfortable in a lot of markets. So I think this is a healthy resetting we've seen. And it's not just the war in Iran. Again, there was software that was kind of bleeding into other sectors over the last couple months too.
I'm going to zoom way out now because there was an interesting piece I saw in the New York Times earlier this week, late last week, by Kyla Scanlon, who is sort of a consumer-facing economics writer, I guess you would call her. And she brought up the idea that has been brought up many times before about foreign buying of U.S. treasuries, but through the prism of this war in Iran and the U.S. sort of as an unreliable partner, if you will. Again, not a new idea, but something that keeps flaring up. Is that something like over the long term you think is going to be more at risk?
Yeah, I think in the short term, the United States benefits from the fact that there really is no alternative that can handle this kind of size. We have 36, 37 trillion, and there's no one market that can replace us. Now, you don't want to kind of just sit on your hands and assume it's going to be that way forever. I think what we've seen is, though, that over the course of the last kind of year, 12, 18 months, some investors are looking to diversify a little more out of the dollar. They're looking to kind of put money to work in Europe, in emerging markets, and you're seeing kind of positive flows into emerging markets. So I think that's something that we don't want to assume we will be the reserve currency forever. Certainly we are today, and we benefit from that with lower treasury yields. But it's something that it's certainly, the more kind of adversaries we make over time, the more negative effects that's going to have. I think the other thing that's going on at the same time is that you have the austerity age in Europe is over, where they're issuing more debt. You have China that's issuing more debt, Japan. So these things are all coming together all at once, and it just means that what I think it means is there's going to be more term premium to go out 10, 30 years on our treasury because there's more supply and there's also more uncertainty.
And we talk on the show a lot about international equities. We talk less about international debt just because it's not something that a lot of retail investors are in. But of those markets you're talking about, there are alternatives. Yep. What's attractive to you there right now?
Yeah, look, I think that one of the places we like, just in general, just to kind of paint a broad brush, is emerging markets that for years you had these negative technicals. And really coming out of the pandemic, what we saw is central banks in most of these emerging markets didn't have the same leeway that the Fed did, where they couldn't just say inflation is transitory, we're going to wait and let inflation kind of fizzle out. And so they led this hiking cycle, and they've been kind of leading this cutting cycle. And I think that's something that you're now on the kind of tail end of that, and you're seeing that things go the other way, where on top of that, you're also seeing kind of positive bond fund flows, like going back to our last question, where people are looking to diversify. We've seen kind of 9+ months straight of positive flows into just general emerging market bond funds. Right. And I think that's a nice catalyst going for the next kind of, year or so.
Gotcha. Andrew, thanks for coming in.
Thanks for having me,
Good
Julie.
to see you. And just wanted, before we leave you, to take a quick look at Polymarket odds on the chances of a U.S. recession, because this is sort of informing our conversation as well. By the end of the year, the odds currently stand at 31%. So not huge, but not nothing. For more Polymarket odds, you can scan the QR code on your screen to go to the Yahoo Finance Prediction Markets Hub, powered by Polymarket. And that is for Market Catalyst. I'm Julie Iman. Thanks for watching.